Good evening, ladies and gentlemen. A very warm welcome to the Q4 and full year FY24 earnings conference call of Hinduja Global Solutions Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Snyder from Adfactors. Thank you, and over to you, sir.
Thank you, sir. Very good evening, everyone, and welcome to the earnings call of Hinduja Global Solutions Limited for the 4 and financial year 2024. From the senior management, we have with us today Mr. Partha Devatkar, Full-time Director and Group CEO, Mr. Vinci Fernandez, Full-time Director HGS and Head of Digital Media Business, Mr. Srinivas Palakudetti, Global CFO, and Mr. Lakshmi Narayanan, CS, Chief of Staff, Next Digital, and CFO, One OTT Entertainment Limited. As a reminder, before we begin the earnings call, I would like to mention that some of the statements made during today's call might be forward-looking in nature, and hence it may involve risks and uncertainties, including those related to the future financials and operating performance. Please bear with us if there's a call drop during the course of the call. We will ensure that the call is reconnected at the earliest. I would now like to hand over the call to Partha, sir, for his opening remarks. Thank you, and over to you, sir.
Thank you, and a very good afternoon to all of you. Before I get into the details of the call, I wanted to make sure that the audio is clear. Can anyone confirm on the call if the audio is clear?
Also, Vinci, you're loud and clear.
Perfect. Thank you, Vinci. Okay. So once again, good afternoon to all of you, and I am on the investor presentation deck, slide 4, that has been circulated and is also available on the website. So happy to announce that we have moved into South Africa, Rainbow Nation as it is called. We have just incorporated a new subsidiary called Team HGS in South Africa. As of March 2024, we expected to start operations in either Q2 or Q3 of this year with a center in Cape Town. And we're expecting to be able to support clients primarily from US, North America, and Australia from Cape Town. South Africa is quite a mature destination so far as international outsourcing is concerned. It's a preferred delivery destination for UK, North America, and Australia based. It's got a good reputation of a very well-educated workforce, and Cape Town itself has about 80,000 full-time employees who support international clients and create about 10,000 new jobs every year. Very happy to finally make our footprint in South Africa. It has been something that we have been considering for a while, and we should be able to start off within this calendar year. I'll move to slide 5 now, and I'm also very happy to announce that we started our cybersecurity practice. It is something that we announced about a month back. It is the most comprehensive cybersecurity solution for the market. As all of you know, with artificial intelligence making such a big splash with businesses worldwide, concerns about security and protection of data, privacy, and other matters is becoming of paramount importance. So our cybersecurity solutions secure artificial intelligence workforce, security testing, digital forensics, vCISO and staffing. vCISO means a virtual CISO and staffing. We can also provide that. Secure automation and SOC as a service. Security Operating Center is the acronym for SOC. There is a large market for these services across industry verticals, and we believe that it's going to be a very attractive target market for all of us. And this obviously leverages cutting-edge technologies to secure many AI and ML applications that are rapidly gaining ground in this year. A quick recap of a fairly busy year that has happened in AGS. For the shareholders' perspective, we completed our first ever buyback. 60 lakh equity shares were bought back at a price of 1,700 rupees per share, and we returned about 1,020 crores to our shareholders. I'm also very pleased that we were able to announce a dividend of rupees 7 per share, which turns out to be at 25% of our consolidated profit after tax. You also know that last November, we had launched our center in Barranquilla, Colombia, to provide support for English, Spanish, Portuguese to North American clients. I'm happy to announce that that particular center is almost full, and we have about 200 people who are working for us there. Artificial intelligence and generative AI, we are setting up labs in Bangalore and in US for multiple CX-driven use cases. We also have developed our own proprietary platform, AgentX, and I'm happy to report that that has now been deployed across 16 plus clients. You also know that in the Americas and in UK, almost 95% people work from home, as a result of which through the last 2 years, we have been trying to consolidate our brick and mortar footprint to a bare minimum that is required to support a hybrid workforce. We have continued in that, and we've been able to shut down 4 centers that we have during this whole year. I'm also very happy to report that Next Digital launched Telluritics, a comprehensive suite of enterprise WAN solutions for enterprises. Very excited about that. And Vince, my colleague, will cover that in great detail. And the subsidiary Oil has completed a majority acquisition, 51% of a leading Mumbai-based ISP, 7 stars. On slide 7, our other income has increased by 62% almost, and profit before tax has also moved in positive territory. Very, very sharp improvement in profit before tax, as you can see from the figures in slide 7. Coming to slide 8. A comparison of FY23 with 24. Again, very good improvement in operating revenue and even better in operating EBITDA, with operating EBITDA improving by 45.8%. Other income has, however, come down slightly to the extent of 6%. And our CFO, Pala Kodeti, will cover that in great detail. There's no reason to be concerned about that. Coming to slide 9. As you know, acquisitions have been a significant part of our growth story historically. We just completed an anniversary of acquiring TechLink, which we acquired in Feb 2023. I'm happy to report that TechLink has done very well. Its revenue for FY24 was 36.6 million. Its EBITDA was 23.9% for the fiscal, and we are making good progress on cross-sell opportunities and have signed several engagements with existing HGS clients. Similarly, we are also able to sell HGS services into TechLink clients. The other acquisition that we did in Australia in February 2022, March 2022, has also done well in FY24. The revenue grew by 26.3% on a year-on-year basis, but more spectacular was the improvement in EBITDA that grew by about 35.4% for this year. Moving to slide 10, at a very high level, we are transforming our CX operations using applied analytics and AI. And we are customizing our horizontal solutions for fast-growing verticals. We are in the process of shortlisting a few verticals that we are going to strengthen and focus. AI-led process management solutions, deploying many Agentex licenses and GenAI platforms to improve the customer journey. We have spent a significant amount in building up and scaling our sales teams across North America, UK, and Australia in the hope of capturing a fast-growing market that all of us are excited with, the advent of AI. Our pipeline looks good. We had a slightly slow year last year. 2.5% revenue growth is not spectacular, but we hope with a scaled-up sales engine across the two major geographies, our growth in the coming year will be much better than it was last year. With that, I'm going to put myself on mute and hand it over to my colleague, Vince Fernandez. Vince, over to you.
Thank you. Thank you, Partho, and good afternoon to everyone. I hope everyone can hear me loud and clear. And Shilpa, Tanuja, if you can confirm that my voice is okay?
Yes, Vince.
Yes,
thank you.
It's okay.
Thank you. Thanks, Partho. So I'm going to go straight into slide 12. But before I actually talk about it, I think if you recall, if I'm not mistaken, probably the last fiscal 23 call that we had, we spoke about how we were going to leverage as part of HGS the incredible pan-India network that we've built and the infrastructure that we've built for the way forward, which is driving retail broadband, enterprise class solutions, and of course commercial broadband as well. That being the future growth of this country and being part of the digital inclusion that the government has been pushing so hard. And we're very delighted that Celeritics, slide 12, if you look at, which we launched just a year ago, well, actually less than a year ago, set up specifically with very unique and innovative products ranging from SD-WAN and security to broadband over satellite and network as a service solution, has been able to make significant inroads. The solution is one of the first products that, actually one of the first early products that we developed along in synergy with HGS's tech team and Next Digital. And this solution called 1X that we've launched recently has already seen some major traction. It's a very interesting product. Just to give you a very quick background, the challenge for smaller banks or credit, I'm sure you know India is a very strong network of cooperative credit societies. The moment you step out of the cities, cooperative credit societies are the mainstay, the main backbone for financial transactions. And often they face challenges of data security, challenges from threats from networks, etc. And this product 1X that has been launched is a unified network as a service solution that will benefit even the smallest of credit societies, because this essential service to prevent cyber attacks on their network infrastructure or anything is now available to them at a democratized price. So we're actually looking at extending this to as many credit cooperative societies in the country. And we're very delighted that a few months ago, we entered into a strategic partnership with Maharashtra State Cooperative Credit Society, or MAFCOCS. This partnership allows us basically to offer our services to over 40,000 branches of MAFCOCS's cooperative credit societies in the state, and with the potential to, of course, expand to about 100,000 branches nationwide. So we've already received, very proudly, we've received our first order from Samta Sahkari Patsanstha for its branches across Maharashtra. We are in the process of implementing that project, and we believe that that will set the tone for credit cooperative societies nationally to be able to put in the best of class technology without having to spend, without having to go burn their pockets to a great extent. So this is a fantastic product, and if you look at slide 13, it's been, it got a lot of traction in the media as well, because clearly you can see that the input or the objective of this product will be a game changer going forward for cooperative credit societies. That is something we're very proud about on slide 13. If I go to slide 14, and Partho, my colleague, mentioned it, I come back to retail and commercial broadband. This has been the driver for us in this fiscal. In fact, we have continued to push broadband as being the mainstay, because while India may have close to 200 million homes, barely about 35 or 38 million actually have a wired, I refer to specifically, broadband connection. And the kind of potential to grow, improve ARPUs is very significant. And even a company as large as Hinduja Global Solutions needs to have strong partnerships to be able to penetrate such a huge, expansive market that's available. So one of the steps we took was completing a majority acquisition of leading Mumbai-based ISP, 7stars broadband business. They're basically very strong in western suburbs of Mumbai and the rest of Maharashtra. And we've already acquired a majority stake, and we're already growing the business. It's not just focused on increasing broadband penetration, but also the idea is to offer customers a much wider portfolio. We're currently, even as we speak today, we're testing our IPTV solution, which gives you a digital television or a cable television-like experience using internet protocols. Of course, as you know, OTT is already available from us. We have an aggregator product called NextPlay. And we've extended this relationship also to Triple Play, a very strong player in the National Capital Region across Delhi and the entire NCR. And more importantly, I think what attracted us was the strength of Triple Play in the commercial hub of Gurugram. You have so many companies there. They all, are looking forward to quality of service, and we're working very closely with Triple Play to elevate and the quality of service that we provide. This relationship is a strategic alliance, and we are looking to engage in further strategic alliances across the country to be able to offer customers not just a quality of service, but also a wider portfolio of services. Again, we delivered in the case of Celleritics, if you look at slide 15, very, very well received by the media in terms of coverage all across the country. And that shows that we're on the right track of all the foundation that we laid in FY23 and earlier has started to pay off handsome dividends in 24. And if you go to slide 16, as they say, the evidence of all the efforts should be in the results. And I think the results are very, very obvious for everyone to look at. We've looked at our broadband subscriber base, and I'm talking about the retail base growing from about 1 million, around just below 1 million customers last year, rounded off to about 1.22 million, which is about a humongous 23.8% growth in a year. And we've been able to control broadband churn, very, very well marked approach in terms of growing, and all that is a result of quality of service. Similarly, our digital television subscriber base. A lot of couple of questions have come up in the past about the future of digital television. There is still significant headroom in tier 3 and rural markets where penetration is still highly limited of digital television. And Next Digital has the unique advantage of having the only head-end in the sky platform where we can deliver digital solutions through satellite. So effectively, overnight, anyone in the most remote area of India could install this service and pretty much go live. And we've seen traction on that as well, with the base growing by about just over 8% year on year to about 4.43 million. But I think what's really notable about this is the second piece, which is the churn. The industry level we know is significant double digits, annually, as you know, in the low 20s or mid 20s annually, and we've been able to buck the trend and literally halve that. So overall, if I had to step back a bit and say, the objectives that we set out for FY24, were we on course? Yes, we were. We looked at 3 clear aspects. We looked at Celeritics being our future driver for high value customers, high value, low volume enterprise customers. That has taken off brilliantly, and launching 1X and signing up with Mascox, it's achieved its objectives. Retail broadband has seen significant traction, which is our volume driver of being able to grow the retail broadband across the country. And the third vertical, which is digital television, has continued to make inroads into markets which are still underserved to a great extent, tier 3 and rural markets. So overall, like I said, we've focused hard and we've been able to achieve that. And we hope to continue on this trend going forward. And thank you very much for joining us today on this call. Truly appreciate that. With that, I'm going to hand over to my colleague, Pala, who is the Global CFO for the business. Pala, over to you. Thank you.
Thank you, Vince. Good afternoon, everyone. Thank you for joining this call and welcome once again. I am on slide 18. These are the results for the quarter ended March 24. As you would see, on a year-on-year basis, our revenues are up about 2.7% between quarter ending March 24 and March 23. Other income is also up by about 62% on a year-on-year basis. But while the growth in revenue at an overall level may look soft, I think the focus, I would like to draw your attention to the operating EBITDA numbers, because excluding the other income, there's been a substantial growth. EBITDA at 66.2 crores is about 82.5% higher than the quarter ended March 23. And this has clearly led to significant improvement in the EBITDA margins. So our operating EBITDA margins are up from about 3.4% to 6%. So clearly, as both Partha and Vince mentioned, there is a lot of focus on improving the margins of the business, while the revenue growth may be slightly on the lower side. Moving on to slide 19. This is the full year performance. Again, revenue from operations have grown 2.5%. A couple of drivers. We have taken a conscious decision to reduce the onshore revenues in markets where the profitability is less. And we are encouraging our clients to move from onshore to offshore to delivery locations like India and Philippines. So clearly, while the profitability improves, as these clients move work from onshore to offshore, there's clearly a reduction in the billing rates, and the margins also, and hence the revenue growth will look muted. But if you focus the operating EBITDA line at the bottom of the table, it's a very good story. Revenues, operating their EBITDA has improved close to 46%, And at an overall level, our EBITDA margins have expanded again significantly from 5.4% to 7.7%. As Partha mentioned, there is a reduction in other income between March 23 year FY23 and FY24. Three drivers. One, because of the exchange rate variation, we had FX gains of about 57 crores in FY23. That has come down to about 20 crores in FY24. Also in FY23, Partha had mentioned that we had done some rationalization of the real estate. We also sold off a couple of properties outside India, and clearly there were capital gains from that, which also sits under other income. So these are the two broad drivers for the drop in other income: lower FX gains and lesser amounts from sale of property, leading to the drop of roughly about 30 crores. This has resulted in a slightly lower PBT. You see the PBT drop is coming largely from the drop in other income because EBITDA has clearly increased substantially. Last year, we did have some benefits from profits from the discontinued operations or sale of the healthcare business. And so total PAT for the period last year was 334 crores. And also the tax reversals line were much higher. At a PAT level, that has come down from 334 crores to FY24, 131 crores. But clearly, we are very happy with the overall results, given there is a strong improvement in the operating EBITDA, which sets us in a good position to grow in next year. Moving on to slide 20. This is the balance sheet. Couple of call-outs. You would see on the share capital, there is a reduction from 52.5 crores to 56.5 crores. That's clearly because of the buyback of 60 lakh shares. Partha had mentioned this, which was completed in June of 2023. The DSA days remain strong and unchanged at 59 days, which is par for the business which we are in. Nothing major to call out from a cash flow perspective. As just to highlight, 1254 crores was the outgo on account of the buyback and the taxes of the buyback, which was incurred by the company. Moving on to slide 22. We have a strong balance sheet. Our net worth is about 7,643 crores. Gross debt is about 1,305 crores, giving us and we have a net cash and treasury surplus of about 5,000 crores. Given the low debt and the large equity base, so from a gearing ratio, leverage ratio point of view, we are in a very strong position. And we have totally about 6,400 crores of surplus cash in the form of investments, loans, bank balances. After adjusting for borrowings of about 1,305 crores and things like unpaid dividend, we have a net surplus of about 5,012 crores, which is available for funding future growth. Moving on to slide 23. This is how our revenues are generated. We have about 50% coming in from the BPM business and 37% coming from digital services, which includes the digital media business. Moving on to slide 24. On a full year basis, about BPM accounts for 55%. The digital services, including the digital media, accounts for about 36%, and 9% comes from other income. Moving on to slide 25, on the operating revenue side, if you look at the table on the chart on the left, in terms of delivery recursion, India is obviously the highest, 42%. This includes the digital media business, as well as what we do work in India for servicing our clients from US and UK. USA accounts for about 20%. This is the part which has come down significantly as we are shrinking the US onshore business. And Canada and UK are the mixed biggest geographies, accounting for about 14% and 9%. If you look at the table on the right-hand side, that is the revenue by origination. The India business is 34%, which is primarily the digital media business and our HRO business. Then US is the second largest at 33%. Both onshore and offshore come as part of 33%, followed by UK and Canada at 13% and 14%. And as Partha mentioned, our Diversify acquisition is doing well, growing rapidly, and that hence it accounts for about 5% of our revenues for the quarter. Moving on to slide 26, similar view. This is for a full year basis. I think that the nature does not change. I won't spend too much of time on slide 27. If I go to slide 28, this is our revenue by vertical. Clearly, media accounts for the largest share at 32%. This consists of the media business in India, as well as clients in USA and Canada from the media business, followed by consumer and retail at 20%. And then we have BFS at 14% and technology at about 13%. The public sector is 9%, primarily from clients we have in USA and Canada and one Canadian client. Moving on to slide 29, this is the client concentration. We are in a comfortable place there. Top customer accounting for 9%. And if you take the top 5 or the top 10, including the top 6, top 5 will account for about 26%, and top 10 account for about 36%. So we have a fair amount of wide diversity in terms of clients who account for the remaining 64%. In terms of DSO days, no change. It has remained at 59. So we are good from a revenue generation as well as from a collection point of view. And the DSO days are for the overall company, including the BPM and media business. That's all I had on terms of presentation. So now we would like to open the floor for questions and also like to use this opportunity to hand it back to the moderator.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Narendra Gandhi, an individual investor. Please go ahead.
Hello. Hello.
Please.
Yeah, hi, sir. So, could you give some qualitative view how we should see growth and margin for broadband and digital TV business?
Right. So, Narendra, thank you very much. This is Vinsley. I'm assuming, Narendra, you can hear me, right?
Yes, sir.
Okay. So, Narendra, the broadband business, the challenge in giving you a qualitative aspect is such, because there is such a wide range between a 10 Mbps pricing and a 1 gig pricing. But I'll try to kind of sum it for you when you look at an average revenue per user, etc. Right? ARPUs in the key cities, strangely enough, are actually plateauing out, while as ARPUs in tier 2, tier 3, and tier 4 markets are actually growing, because of the lack of a qualitative service in those markets. So people are willing to pay more for a better quality of service available to them there. Therefore, you'll end up as high as about 35% in terms of your effectively your margins in markets like those. While as in the city markets, you'll probably go down to anywhere between 16 to about 25 to 28%. I'm giving you the industry kind of approach. From our perspective, we've always promoted a mix, and that's why I mentioned to you that, how do we challenge it out? We proposed a mix that we're working on. So in the cities, we try not to sell broadband on its own as an individual product. We bundle it along with an OTT aggregator service, or we bundle it along with our digital television platform, which is already available. From a growth perspective and the kind of horizon that we're talking about, like I said, we've seen a 23% growth already year on year. Would we continue with that aggressive growth? I'll actually give you a slightly different answer. What we'd like to do is every time we grow, there is a following up harvester mechanism. So there is a hunter mechanism which has now been put in play, which is to grow the business by 23%. Then there is a harvester mechanism which focuses on improving the value derived to that, delivered to that customer, and therefore getting a greater share of revenue, pushing ARPUs up by offering IPTV, pushing ARPUs up by offering OTT and other bespoke services. I hope I was able to kind of give you a sense of that.
Also, I wanted to ask that going ahead, is it that broadband would entirely compensate for degrowth in digital TV business, or you still feel that good amount of growth left ahead for the segment?
Yeah. So, Narendra, I believe, and not just believe, belief is one thing, as they say, results are another thing. If you look at the deck that I presented and go to slide 16, our DTV base has been increasing, and there's a unique reason for that. The degrowth that you're talking about often happens in the cities where people at some level, at the top level, kind of move to OTT and don't necessarily renew it for the second television and third television at home. So they've got 3 TVs. They'll switch to OTT and they'll retain only 1 TV on a DTV, digital television service. For us, because we're unique and we have the head end in the Sky platform, and we're the only company in the country today to have the head end in the Sky platform, we're catering, our growth is being seen from markets which are tier 3 all the way down to rural. So growth for us we've seen in distant markets in eastern parts of Uttar Pradesh and certain challenged, as in underserved areas of Andhra and Telangana, Maharashtra, certain regional pockets. So growth will continue to happen. Will it be the heady, rapid growth that you saw in the years, earlier? No, definitely not. But I think from our perspective, when you look at the industry and the industry is actually showing some level of degrowth and we are actually showing growth, it now reflects clearly on the delivery mechanism, because it's easier to go via satellite to a customer in a remote location than to go on a wired basis to customers. So digital television will continue to grow. Having said that, we are very clear that all the verticals have to grow in parallel. But in terms of focus, our focus for the next few years, the next several years, is how to accelerate our broadband subscriber base, because we believe that's where the value creation is significantly, while digital television continues to provide that really strong, rock-solid foundation of being present in multiple PIN codes, 4,500 PIN codes in the country. Narendra, I hope that is...
Yeah. Thank you so much, sir.
Thank you. Thanks, Narendra.
Thank you. Before we move to the next question, a reminder to the participants: to ask a question, you may press star and 1. Next question is from the line of Vivek Jhala from Jhala Family Office. Please go ahead.
Hello, sir. I've just got 3 quick questions. The first one is, if you could speak about your head end in the Sky technology, basically what are its key USP compared to DTH and so on?
Right. Are you going to list out all 3 questions or would you just like me to answer each one, Vivek?
However you're comfortable.
Okay, I'll tell you about HITS. So HITS is a very unique technology, and Comcast is a great example of it in the US. See, India, why is HITS very relevant for a country like India? There are 3 or 4 reasons. What HITS does is delivers a signal like your DTH. It delivers a signal via satellite. So wherever you're in the country, wherever you're in the in the geography of India, you can receive this service, this signal from the satellite over India. But what makes it unique is this service is in C-band as against KU band, which DTH is in, and which therefore does not get affected by or does not suffer significantly from rain attenuation. C-band is a particular kind of band which doesn't get affected. That's the second thing. Third, why does it make it unique is that our entire focus is rather than increasing the cost to consumers, we work more on a DTN model, which is direct to network, where all someone has to do in, let's say, in a hamlet of, or a village of 500 homes, is the local cable operator who invests in the technology, which is nothing but the size of a refrigerator, and he puts dishes that receive the signal and he redistributes them to his entire village or entire town or mini township. So it's very unique in its aspect that it doesn't require, I do not need to connect my Mumbai digital head end or my Delhi head end to these locations physically by fiber, right? And therefore be subject to the vagaries of whether, fibers getting cut on highways where there's so much. Don't forget, India, we're significantly invested in infrastructure work. So you have highways being built, you have bridges, tunnels. So there's a lot of vagaries, a lot of impact or challenges to terrestrial fiber. I'm talking about intercity. So delivering signals via satellite are definitely a huge advantage. And that is one of the reasons, that is the key reason, Vivek, why we've seen traction on the digital television subscriber base.
Okay, thank you, sir. Second question is, what would be your strategy ahead with regards to the net cash and treasury surplus that you have?
Okay, I think that's for Pala. Pala, would you like to take that?
Yeah. Thanks, Vivek, for the question. Clearly, we do have a net cash company. And as you have seen, we have done acquisitions. So we've acquired, the sale of the healthcare business. We acquired Diversify, a company in Australia. We've acquired the TechLink business. We've also made investments in 7-Star. And we are also using this for organic growth. We have started operations in Colombia, and as we mentioned at the beginning of the call, we are soon going to start operations in South Africa. So it's going to be used as a combination for organic growth as well as for acquisitions, which will be strategic in nature and adding to our overall capabilities and offerings.
Okay, thank you, sir. And this is the last one. Has our business mix changed substantially over the last few years from traditional CX to more digital and digital operation? And if you could just shed some light briefly on each of these segment mix.
Partho?
Yeah, so we have that on one of the slides. I'm trying to pick up that slide which talks about the segment mix. Just bear with me. Yeah, if you look at slide 24, you will see that the total income has been split in percentages. So the BPM business constitutes now only 55% of our revenues, whereas the digital service is about 36%. So that's the current mix, and we expect that the digital services will go in as a percentage of revenues. The digital services are going to grow both organically and inorganically. You will find that our share from only labor arbitrage-driven services will go down as we implement more transformative solution around Gen AI artificial intelligence, and the new technologies, cloud, I talked about, cyber security and all of that. As we do more of these, our traditional revenue stream, which used to be almost all labor arbitrage driven, is going to go down.
Okay. That's all good. Thank you for answering my question, sir.
Thank you. Participants, to ask a question, you may press star and 1. Next question is from the line of Hina Parekh, an individual investor. Please proceed. Ms. Hina, your line is unmuted. Please go ahead with your question.
Hello, am I audible?
Yes, you are. Please proceed.
Yeah, hi. So first of all, congratulations on such a good set of numbers. I had one question. If we see the results, there was a substantial turnaround in your media business margin. So what could be the key drivers for this growth?
Pala, you want to mention it from a financial perspective before I get into the business aspect?
No, go ahead. You can explain she's clearly saying there is a improvement, so you want to understand what it is.
Yeah. So Hina, thank you, first of all. Thank you very much. Truly appreciate it. Like I said, when I started talking, I mentioned, Hina, that we set ourselves on a commitment last year, right? And the commitment was to build 3 clear pillars, right? To ensure that digital television, which, very often some people unkindly refer to as a sunset sector, but failing to note that India is not just, India is still, for me, India is Bharat, right? In the markets that are way outside of the cities. And that's where there's significant growth and there's significant aspiration and disposable income. And digital television has been growing there significantly, which shows the approach that we followed. Secondly, we were very clear that broadband must be a driver, but broadband at a level of quality. Customers are willing to pay more as long as they have a significant quality of service being provided to them. And again, tier 2, tier 3 markets, tier 4 markets, we've been able to look at developing solutions and therefore pushing up the quality of service and therefore ensuring that we're working on, not necessarily working on wafer-thin margins, but working on margins that we believe are our birthright, right? If you're providing a high quality of service, then we should be able to provide get paid for it as well. And customers are very happy to do that. Third thing is, from a Celleritics perspective, we believe that the enterprise business will drive that aspect, will drive significant large projects. We've signed some very large projects in this last fiscal. We hope to continue that. And yes, we've had some aspects of other things that we've done, like fiber transfers, etc. So I think by and large, we're on the right track to do what we set out to do last year. And I think from my perspective, I want to thank people like you and Narendra and others who've been individual investors and kind of kept your faith in us. I hope we're able to make sure we deliver these quality results year on year. Thanks, Hina, for that.
Thank you so much. Another question on considering the CX potential in the market, comparing with the major players over the last 1 year, is it creating growth opportunities for mid-sized players like us? Hello?
Yeah.
I think that is a very interesting question. See, the future of CX is all through technology. And the firms who are able to deploy technology to improve or transform CX experiences are going to be the market leaders. We have invested in developing technology leadership in CX since 2018 when we acquired Element Solutions. And then in 2023, we acquired our data and analytics firm called TechLink. Those are going to be the foundational capabilities that are going to allow us to deploy technology at scale using artificial intelligence and more specifically generative AI. Today, I don't know if you know that, most of the large brands today, it's very difficult to reach them. The call goes on hold for a long time before an agent picks up. And some of them have deployed bots who try to help, but these bots are really very inefficient, very unintelligent, and often extremely frustrating. So the customer experience is very poor today. As generative AI gets deployed at scale in some of these customer journeys, that is going to be a massive improvement opportunity area. That's what we are aiming to get into, and where our technology capabilities will lead us.
Okay. So like you mentioned about the generative AI, so how are we prepared to defend against potential margin pressures if there are in generative AI? Because it indeed leads to increased challenges in the coming years.
No, actually, it is just the opposite. Generative AI, the technology, is going to be a massive opportunity area for firms like us, because we are going to deploy them, for the clients that we work with. So we are going to be almost, what I would say, is almost a conductor of orchestra. We are going to bring in technologies that are being developed by firms like OpenAI, Microsoft, Google, etc. And we know the customer experience because we have been handling them for multiple decades. So we have all data available, which will allow us to train these AI models in the most commonly asked questions that people have. So when a consumer has a question, the generative AI model will be able to answer that question in a much more effective way as opposed to the unintelligent bots that get deployed today. And through conversational AI, actually you won't be able to differentiate whether it is a human agent speaking or whether it is a generative AI-driven bot speaking.
Right.
So as a result of this, what will happen is that the wait time that you have today before a human agent comes down will go down substantially, but you wouldn't even know that you're not speaking to a human agent. The technology will be so good that the generative AI-driven bot will be able to answer your questions, and you won't be able to know whether you are speaking to a machine or whether you're speaking to a human being. So that is the technology that we are honing our skills on, and therefore we believe that this is going to be a substantial opportunity for all of us.
Okay. Thank you so much, sir.
You're most welcome.
Thank you. Participant who wishes to ask a question may press star and 1. Next question is from the line of Anuj Panwar from Family Office. Please proceed.
Yeah, hi. Thank you for the opportunity. I just have one quick question. Recently, I read that the Hinduja Global Solutions is selling its optical fiber assets to its subsidiary, the IMCL Solutions, for around 200 crores. So I wanted to know how will this transaction affect our profitability?
Paula, would you, CS, Lakshmi, you're on the call. Would you like to answer Anuj in terms of from a structuring perspective?
Sure.
Yeah.
This is Lakshmi.
Yeah.
So, in the last quarter, we had sold assets to a subsidiary company called Industrial Media and Communication, and there was a profit about 44 crores that got recognized in the other.
Yes?
Since you are able to hear me?
Yeah, I'm able to hear you. Go ahead.
I clarified whether there was a profit element, and it was indeed, and we had recognized it as part of other income.
Okay.
Okay. Thank you. That was helpful.
Yeah. Thanks, Anuj.
Thank you. As there are no further questions from the participants, I would now like to hand the conference over to the management for the closing comments.
Partha, would you like to go first?
Yeah, thank you very much for joining us in our earnings call, and we look forward to talking to you again when it comes to August for our quarter one results. Once again, appreciate your taking the time and for the great interactions that we had. Bye-bye.
Thanks. Pala, would you like
Thank
to?
you, everyone.
Yeah.
Thank you, everyone, for your joining us on this call and for your feedback and thought-provoking questions. We look forward to interacting with you soon.
Thank you on behalf of everyone actually at Hinduja Global Solutions. All of us, it's been a great year, and as Partho has expressed, challenges abound, but we are there to kind of surpass them, and I think true credit goes out to everyone across HGSL. It's been a wonderful interactive call with everyone, and our entire team, of course, remains available in case if you'll have any queries beyond this call. But thank you so much for taking time, and that too on a Friday evening. Much appreciated. Snyder or Yusuf, over to you, I guess.
Thank you very much, sir. On behalf of Hinduja Global Solutions Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.